It's game over for the Fed. In an attempt to save the banks from all this liquidity, the Fed's going to crash the market. And in today's macro show, I'm going to show you exactly how that can happen. I'm your host, Steven Van Metre, and thanks for joining me today. Now, you might know that I've been on some shows recently, my friend Jay Bravo's show, and we talked about this reverse repo problem. We've talked about it on this show and how I really am not convinced it's this huge deal. But I'm going to show you today how it can be and is likely not because of the reverse repo problem itself, but to all the circumstantial things going on around it and how the Fed is boxed in. They are trapped, and the only likely outcome is they're going to crash the markets. Now, you've heard some people say the Fed needs to raise rates. I'm going to show you why they can't do that. Some people have called for quantitative tightening. I'm also going to show you why they can't do that either. Some people have said the Fed needs to taper its QE. I'm going to show you why they can't do that either, and that the long run, it could be in the short run, outcome is lower stock prices. Now, before we get into that, I was recently interviewed by Neil McCoy Ward. Now, if you've listened to the show, if you're a fan of his YouTube channel, you'll know that in the beginning of the show, for the first half of it, I actually call him Noah. And I want to publicly apologize to Neil, and I've actually already apologized to him because I got confused. I actually had him and a fellow named Noah, who I'm being interviewed by tomorrow, confused and booked on the same day. And when we got on the interview with Neil, well, his name wasn't under his picture, and his logo wasn't there either. And I thought he was Noah. And he didn't hear me calling him Noah. And so for the first half of the interview, I referred to him as Noah. He later said it's not a big deal. Peter Schiff couldn't remember his name. So with that, I have apologized to him. I hope you enjoy the interview. I'll put a link in the description below. But just so you know, Neil and I are cool, and I'm sure we'll get back together soon and have another great chat. So let's get into this problem of this reverse repo, of all this liquidity, and how it ends in a stock market crash. Because this is really interesting, and no one is looking at it from this perspective. So let's just set what the problem is. There's too much cash in the banking system. Now, how do we know that? Well, there's this overnight loan called the reverse repo, and today it hit $583.9 billion. And so what you're seeing there is the banks have too much cash, and they don't have the right collateral to match it. So there's a collateral shortage. So when you see reverse repo, it's a collateral shortage. When you hear repo, it's not repo like they're coming to take your stuff. It just means there's too much collateral. So you have two opposite ends. And what is the repo and reverse repo operations designed to do? And that is stabilize the money markets. You give too much cash, you can drive money market rates negative, which is a concern right now. You have too little, and you can cause them to go up. So the Fed tries to stabilize them when things are not right through repo and reverse repo operations. So we know for a fact there is a collateral shortage. And so to solve this problem, at least temporarily, the Fed is offering per counterparty up to $80 billion a night of 0% interest loans, with the option at the discretion of the Fed chair to increase that amount to any number Fed Chair Powell wishes. And you can see that right here on the reverse repo operation for today, June 14th, $583.892 billion, and the rate was at 0%. So this is simply, and you see one day, it's an overnight loan. So all it's designed to do is take this cash out of the banks to keep money markets rates from going, at this point, negative, and swap them with pristine collateral that the Fed has. Now, there's a number of ways this can be fixed. Let's go through all of them, and we'll find out. You're going to see, I want you to see just exactly how trapped the Fed is and how they only have one choice to continue with, and how that is going to crash the markets. So what could the Fed do? Well, we know for a fact the Fed has the collateral the bank wants because they're doing this reverse repo operation overnight. And where do we see that collateral? Well, you see it on the H.4.1. And here is the Fed's balance sheet. And see U.S. Treasury securities are sitting on $5.1 trillion with $326 billion in T-bills. You see over here, T-bills. And then below that, 4.4 trillion of different notes and bonds. And so we know the Fed has the collateral the banks want. So what could the Fed immediately do this week, because there is an FOMC meeting, and I'm not suggesting this is going to happen. I'm going to tell you why they're not going to be able to do this. But the proper solution for the Fed would be to sell the collateral they have on their balance sheet to the banks. And what do we call that? Quantitative tightening. That is what the process is for the Fed selling collateral to the banks. So let's just pretend the Fed tomorrow comes out and says, not only are we going to stop doing quantitative easing, we're going to do $100 billion a month of quantitative tightening to alleviate this overabundance of cash in the financial system, and we'll continue doing that for however many months it takes until the banks have all the proper collateral they want. Now, what do you think the market reaction to that would be? Oh yeah, the market would be like, just go nuts, all pandemonium, and stocks would probably go down, and interest rates would probably go up, and then they'd probably reverse, and then they'd go back and do it again, because nobody will see this coming. Now, the Fed can't do that, and I'll give you a couple good reasons why. The first one is there's dual mandate, and their dual mandate, if you recall, is to stabilize prices. Yeah, right, good luck with that. But number two, the more important one is maximum employment. So the Fed cannot tighten, and historically has not tightened until we're back at full employment. So they can't do that, because that would look really bad right now with 15 million people on some form of unemployment benefit. Powell has also said, as have other members of the FOMC board, that he will announce ahead of time when they're about to have the actual talk about taper. And he's been very clear otherwise that there will be no change to the asset purchase program at least through the end of this year, maybe even longer. So for him to come out all of a sudden and shock the markets, that's not going to happen either. And even if he did, and let's say he was bold enough to come out and just say, hey, look, everybody, there's too much cash in the banking system and there's not enough collateral. We have the collateral, so we're going to sell it to the banks. And when we're done, we'll go back and do more QE and try to actually educate people on the logical reason why this will fix the problem. Do you realize that Fed chairs are nominated for 4-year terms? And early next year, Powell's term is up. And you might recall that he was nominated under former President Trump's administration. Now, do you think for a moment, if Powell came out tomorrow and said, we're going to go from easing to tightening to fix this collateral problem, do you think he stands a chance of getting his job back next year? Yeah, probably not. Probably not at all. Do you think President Biden would be mad at him? Congress would be mad at him? Everybody's going to be mad at him, and the stock market is not going to like it. So he can't do it, even though that is the solution he should do. He can't. So maybe the Treasury could fix the problem. So we've looked at what the Fed can do, and they can't do anything that they should do. But maybe the Treasury can, because what does the Treasury do every month? They issue debt, and when you run a deficit like we are, well, you have opportunity every month, and in some cases in the bill issuance every week, to issue the correct amount of debt, or the correct quality of debt. And it would be really easy. You just go find out what the banks want and issue it. And we know what the banks want is mostly T-bills and short-term Treasury notes, such as 2- and 3-year notes. So let's just say, for example, Treasury Secretary Janet Yellen came out tomorrow and said, by the way, going forward, we're only going to issue T-bills. We're going to cut all note and bond issuance, and we're going to only issue T-bills until we've dealt with the reverse repo problem, the collateral problem in the banking system. Do you want to know what happened to the markets? They're going to go absolutely berserk, right? Because what is the market going to interpret this to mean? Think deeper. What is the market going to think? There's an inflation problem, and the Treasury knows it. In fact, the Treasury knows it's such a big problem that they're going to have to cease note and bond issuance, because no one's about to buy them, because this inflation thing is real. And you want to talk about absolute pandemonium, interest rates going up, stocks going down. I mean, it would just be bonkers. So the Treasury can't do it either. Janet Yellen has to maintain that everything is cool. And not only that, but the auctions say it's cool. We just saw it last week, the 10 and 30-year auction. Everything's cool. So she can't do it, because you can't upset the apple cart. This is key. The Fed is trapped. So now let's get back to the original problem. There's a collateral issue. Banks don't have what they need. How do you get the banks the collateral they need when you can't get new collateral? That's the key, right? We can't get them because over time, this is what I've said, is a reverse repo problem will eventually go away because over time, there will be enough of the correct collateral issued by the Treasury. I don't know how long it'll take. Could be 6 months, could be years. I have no clue. But over time, it will get resolved. But in the meantime, that's not the answer. So how do you get the banks the collateral they need without having the collateral to give to them? Well, you do quantitative easing. Wait, what? Yeah. So think about what. Okay, so what's the issue here, right? Banks have too much cash. They have to back that cash to pay interest on the deposits. So what do? They buy Treasury securities with cash. Your deposits, my deposits, what they're doing with it. They're buying Treasury securities. It's called a bank reserve. It's called the creation of a bank reserve. Now the banks have the collateral they want. They just don't have enough of it. So how do you fix that problem? Well, the Fed comes along and says, hey, banks, I will buy the collateral off of you. And I remember we've had this discussion. Why do banks? We can go back to a year ago. Remember when I was interviewing Jeff Snyder on Real Vision? Why do banks engage in QE? And we haven't had a fantastic answer. The answer so far, the best one from Jeff has been there's nothing else better for them to do. I'm going to give you a reason they have no choice. They have the collateral. But they can't double use it. They can't say, hey, look, we're going to take one Treasury security and back it with all kinds of extra stuff. Nope, there's only so much you can back it with. $1,000 per Treasury security. You can't do any more. That's the limit. So how do you get more out of your dollar for this case, for your bank reserve? Well, the Fed comes along and says, look, we'll buy that off of you. Banks say, great. And then the Fed takes that Treasury security and immediately lends it back to them in the reverse repo market the next day at 0% interest. And you've heard some people say, oh, well, that's a form of quantitative tightening. Let's dispel that myth right now, because that is not true at all. So when the Fed does the initial swap, they give the banks what's called a reserve asset, and they take and buy a Treasury security, and they buy mortgage-backed securities, but our focus on this is Treasury securities at the moment. And then they're going to turn around and lend that Treasury security back to the banks. But when they lend the Treasury security, they are not equally destroying a reserve asset. That's why it's not quantitative tightening. If there was a destruction of a reserve asset, it would be. Because it's a loan, it's not happening. So what the Fed is doing, and this is brilliant if you really think about the mechanics of this, all they're doing is cycling through the recycling these Treasury securities through the banking system via QE and reverse repo to make sure the banks have the collateral they need. And the banks are saying, look, this is fine. This is good. In fact, it's so good, we're doing $583 billion of this stuff a night. And it's not causing any havoc in the financial system. Now, we can say it is putting downward pressure on Treasury yields because there's all this cash building up, but the banks aren't worried about that. So you say, well, that sounds pretty good. How is this even remotely a problem? It sounds like as long as the Fed keeps doing QE, which kind of busts the whole myth of them tapering or cutting or doing anything, that they've got this solved. But remember, QE has a negative effect. It's because, the Fed can't just get away with something indefinitely without being penalized. That's how they're trapped. Because quantitative easing, does it really ease financial conditions? Or does it tighten? Or does it depend? Well, the answer is it depends. Because it doesn't ease financial conditions immediately. In fact, it doesn't ease them until you get lending growth. So quantitative easing is designed to lower interest rates, trap dollars into the commercial banking system to tighten financial conditions until interest rates are low enough to spur lending growth. So by the way QE works is it tightens financial conditions first, and then it eases. So it all depends on lending growth. So let's take a look at that. Now, we didn't look at this on the Friday show, but here we have real estate loan growth in contraction, commercial industrial loan growth in contraction, total loans and leases at all commercial banks on a year-over-year basis in contraction, consumer credit card loans in contraction. So hey, there's no lending growth going on. In fact, we have lending contraction. So QE is tightening financial conditions. And if you continue to tighten financial conditions, you know what eventually happens? Well, the first thing you'll start to see is interest rates start to drop. Is that happening? Well, let's go and check. Let's pull up what's going on here. We know the interest rates went up today, but let's go look at 30-year yields, for example. Oh, look, it looks like they're more likely to head lower at this point because they've stopped going up as of March and have been trending down. So what does that tell us? That QE appears from a yield perspective to be tightening financial conditions. Now, if you understand that, then you also understand there's a relationship between yields and stocks. When financial conditions get tight and yields head lower, stock prices are soon to follow. So this is what makes this really interesting to me. In an effort to save the banks from all this liquidity, the Fed is tightening financial conditions that's going to crash the market. Now, what's the problem there? What happens? See, this only gets worse. That's why this is the trap. This is what nobody can see. You would never expect to see a market crash, potentially, when there's too much liquidity. It doesn't make any sense. But what happens when stock prices go down? Well, some people willingly sell. Some people are forced to sell through margin calls. And when people sell a security, what do they get? Cash. Oh, wait. Does that mean more money is going into money markets if stocks go down? Yep. And what do you think is going to happen to that reverse repo problem? Oh, it's going to be so bullish, it's going to go through the roof. And how is the Fed going to respond? How does the Fed respond to market crashes? What do they do when stock prices start going down a bunch? They do more QE, right? They do more QE. And what are people going to interpret that as? Oh, well, the Fed's doing it to stabilize the market. No, the Fed's going to do it because the banks are going to be such a dire need for collateral, because all this money now is going to be flooding into money markets from people selling stocks, that they're still not going to have enough. And so the only solution the Fed's going to have to do is to do more QE to recycle this collateral at even a faster rate than they're doing now. But it will be perceived as saving the markets, but it may not actually save the markets, because without lending growth, it further tightens financial conditions. And now you know how this reverse repo problem and quantitative easing can crash the markets, because quantitative easing, when it doesn't work, which is not working now, should be stopped. And the Fed's not going to stop. In fact, we'll find out, I believe on Wednesday is the day of the FOMC press conference. And the expectation, at least from my book, is they have no choice. They can't stop doing QE because the banks need pristine collateral, and they have to keep recycling. And now that you understand it, you can see how likely that the continuation of QE and the tightening of financial conditions caused by QE will lead to a crash in the markets. Anyways, appreciate all of you being fans. Thanks for subscribing. Thanks for liking. Thanks for following the show. We will be back on Wednesday, and what will surely be some interesting macro show to see what the Fed actually does and how many questions they get about this reverse repo problem. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategies. We was prepared by Steven Van Metre. Personal capacity opinions expressed do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.